Okay, let's jump right in here. This is our second video, the anatomy of a candlestick. I'm starting to realize I think that these videos are going to be about 10 minutes. I want to say 5 minutes. I really want to keep them low, but it looks like the amount of data that we're going to have to cover, the amount of information, so you guys understand it. I can keep this simple. Might take about 10 minutes. Okay, so I won't prattle. I'll just get right into it. Okay, the anatomy of a candlestick. A candle is composed of two parts. Okay, it's a wick and a body. And when you're saying candle, okay, what's this guy talking about? Well, let's go back to our charts, okay? Because this, I told you before, is charting software. Rather, this is what charting software looks like. Now, this is TC2000, okay? But it doesn't matter. These little red and green things you're looking at, these are called candlesticks, okay? And a candlestick is composed of two parts, a wick and a body. And let's take a look at one. Here you go. You see, you have a wick and you have a body. Sometimes you'll have a wick on the top and no wick on the bottom. Look, here's a body. You have a wick. Here you go. You got a little tiny wick up top. Look at this. Here's one. The wick on the bottom and a wick on the top. Now, let's get back here. Your green candles represent buyers. It's buying pressure. Red candles represent sellers. It's selling pressure. Okay, so when you're looking at something like this, what you're looking at here is buying and selling pressure. You see these candles are going straight up. These are buyers. These are buyers, and these candles represent what's happening with the price. The price of this is moving up because buyers are buying this. When you see it coming down, that's because people are selling. And this represents selling pressure. They are selling. Okay? And as you see these moves up and down, look at this nuclear rise off of this here. Buyers saw this as a really good buying opportunity, and it's ripped all the way up here. And look at this. Even though there was some selling, there wasn't enough selling pressure to bring this stock back down. Okay? There were too many buyers. Too many buyers, and it kept going straight up. And I'm going to show you what I'm talking about. Look at this chart. This is the volume. This represents the volume of buyers and sellers. These are not candles. This down here represents the volume. Now look at the insane amount of buying volume. These represent buyers. And if you look over here at the price action, this represents buyers in the thousands. So you look over here, and then you look at the number of sellers. Now, when you're doing this live, you can click on this, and there'll be a little, it'll draw crosshairs, so you can match these up. Like you'll see the line, and look at this. So you have your selling candle here, which I guarantee you corresponds to this selling candle here. But how's it going to overcome all of this insane buying volume right here? And then look at the next one. Look how small the next selling candle is, and look how small the selling volume is. And then look, once again, they get blitzed with buyers, and that pushes it to the next level, okay? So this is what this represents. It represents buying pressure and selling pressure. We'll get more into how to read a chart later, but just know that there is a correlation between volume and these candlesticks you're looking at. Buying pressure, selling pressure, okay? So that is what the body of a candle represents, okay? And here's your wicks for highs and lows. And let's just jump right over here to, let's jump right over here. And here we are. We'll bring this up just a little bit. Okay, this is a candle. This is a buying candle. It's a seller's candle, okay? And what do the wicks represent on candles? What does the wicks represent? Well, the wicks represent just what they say here. If you have a wick on top, this is simple stuff. Just think about this. Candles are candles, whether they're buyer candles or seller candles. What I'm about to tell you is exactly the same for either candle. If there's a wick on top, that's the highest the price has reached. If there's a wick on the bottom, that's the lowest the price has reached. Period. That's simple. Okay? It's that if you see a wick on the top or the bottom of a candle, if it's on the bottom, that's the lowest the price got to before it was bought back up by buyers to this point. Okay? This is the highest the price reached before it was forced back down by people selling. Okay? Now the trick to this, if you notice, the open and close is reversed here on these candles. Okay? Now why is that? And this really threw me at first. When I first started trading, it took me a while to get my head around this concept here. And the concept was, okay, how am I going to remember that the green one opens on the bottom, closes on the top? And The red one opens on top, closes on the bottom. I'm not really understand. Okay, wait, I gotta try to remember that. Should I memorize it? Should I put it on index cards? No. It's very simple. I'm gonna explain to you. Price action moves up. Remember that chart we were looking at? Think about it. Let me bring you the chart now. Wait a minute. Okay. This is a perfect example. I'm gonna bring you this chart. I want you to take a look at this. Price action moves up. Okay? This opened here on the bottom. This is where the price action started. And it ripped straight up. Straight up. It closed here. This is where it stopped. See? Okay? Now, the reverse would be sellers. Think about it, okay? Next candle opened here. So you're thinking, oh, wow, it opened here, right? This is good. It opened higher than this last candle, but they were selling and they forced it down. It closed here. Selling candles come along in a downtrend. Look at this. As things are going down. Look, see? So they opened from the top and they closed the bottom. In other words, this could have just kept dropping. Okay, like it would open at the current price, whatever the current price is. And right across here, it looks like the current price would have been somewhere around 198.50, 198.40. This is where the price opened. And then it fell. Where did it stop falling? Where did it close at? Here. At whatever price point that is across there, I think 197.50. See that? Opened here, closed here. Okay? Buying candles are exactly the opposite. The price action, where did it open? The price opened here, and then it ripped all the way up to here. This is where it stopped. Okay? So anytime you're thinking of, well, what's open and what's closed, well, think about it. Buying candles, the price action opens at one point and rips up, and that's where it closed. Selling candles opened where buying candles stopped. Okay? That's generally the way it'll happen unless, well, there are exceptions to that rule. But just remember, okay, that the price action on selling candles opens and then the price plummets, or the selling pressure forces it down. And that's where they stop at. Where they stop at means close. Okay? Where it stops at means that's the close point, where it stopped at. The price might have went this low, but then there were some buyers that bought it back up here, and it finished out here. It opened here, started here, went this high, got pushed back down, okay, went this low, and finished out here. Same thing here. So when this candle closed, if you think about it, when this green candle closed, when the price action opened here, let's say at $99, and it went as high as 100, that means this one opened at 100. The next candle started right here, opened at 100, went as high as, let's say, 101, went as low as 98, and finished out here at 99. You see what I mean? Okay, right across. This is price action here. So all this is represents numbers. Opened, closed, opened where it, and then dropped and finished out here. So, and we're going to actually watch a couple of those candles form. I'm going to open up. Now this is, sorry, give me a second. I talked a lot about TD Ameritrade yesterday and their Thinkorswim software. And this is Thinkorswim. They have an on-demand program where you can practice trading with paper money. What's nice about this is you can run back days. So we're just going to watch a candlestick form. And I set this for 9:30 in the morning because remember the market opens at 9:30 in the morning. So I'm going to set this to go. We're going to watch this run. Okay, it's loading. Okay, here we go. Now I'm going to start this and we're going to watch this go. And let me just get rid of the line I put on here so we can watch this go. Let's get rid of that green line. Okay, now watch this. This candlestick is being formed. Now look down here at the volume. Okay, this is sellers. This is selling pressure. And look what's happening. Look at the spike on this selling pressure and look at this candlestick. These are orders. These are sell orders the minute the market opened. And you're watching this. And when you see that wick went up like that, that's because they were buy orders. And they're, ooh, but there's not enough to combat this. Look at this. It's not enough to combat this. This is a huge amount of sellers. This is huge. And nobody would trade this. You would not, as soon as the bell rang and this first candle started, you jump in. So what I'm going to teach you is going to be very simple. But what you're watching now is you're watching a candlestick get formed now. And I don't mean to cross lessons here, but we're on a 1 minute chart. So each one of these candlesticks represents 1 minute of price action. Now look, here's buyers. But look at the difference. You have way more sellers than you do buyers. So is this candlestick going to make it? Let's see. There probably won't be enough. And look, it flipped. Did you see it flip? There it is. Look at that. There's more sellers than there are buyers. Let's see what happens. And look at this candlestick. This candlestick would represent, this is as low as the price got. You saw it form. And then it came up here. This is the highest the price got. And look at this one here. Now here it comes. The price went this high right here. And it got forced down. Look. Now that's a full seller's candle. You see? Buyers had it for a minute. And the price went this high. And now look. This is full sellers. They're just forcing it down. Look at that. Look at that dump. There you go. But now you're looking at this. You're looking at this as high as the price went. This is the lowest the price went. You see what I mean? This candle opened here a minute ago. It opened here at the top. And it's still going down. But this is where it started. And look, the price went that high. And that's it. And now look, this could just keep dumping for the full minute. This candle could just keep dumping straight down. What we're watching here take place. Look at that. This, okay, these are sellers. This is selling volume down here. These down here, these are not candlesticks down here. This is volume. This is volume of sellers to buyers that you're looking at down here. And it's measured over here in the thousands. Look at this, 60,000, 50,000, 40,000. So you're literally looking at a number. Look at this. You can go directly across. Look at that number over there in the corner. 57,210. Look at that. Buyers. Sellers. Look at that volume. Okay? Look at that. Now look. Here you are. A little bit of volume of buyers coming in. Okay, but is it enough? No, it does not appear to be enough because the sellers are taking over again. And this is how candlesticks form. This is how you end up with these wicks and the body and the wicks, okay? Sellers. And notice what happened here. If you're ever wondering and you're getting confused about where candlesticks open and close, look at what's happening with the price, okay? I'm going to put a line here. Look at what's happening. Okay, with the price. Look at this. Let's thicken this up. I want to show you something here. Look at what's happening with the price here. The price opened at around $257. But look where the price is headed. Okay, the price opened up here, but it's going all the way down. So when you're thinking about these candles here, these red candles, they open at the top, but they close at the bottom. When the trend begins to reverse, the price action will open on the bottom where the price is currently at, and it'll rip to the top and close at the top. You see what I mean? So there you go. And that is probably about as simple as I can explain it. Now here's an example of some bullish candlesticks. And when we say bullish, okay, and when we say bearish, and you'll see all of these kinds of candles on a chart. What they're talking about, this comes from the stock market. I don't know who invented this term, but this is how it goes along, okay? Bulls, it's called bullish because the price is going up. Because bulls gorge. If you see a bull, like watch those bull fights and matadors and stuff, bulls gorge up. Okay, bulls gorge up with their horns, and bears slash down with their claws. Okay. If you think about like that, what was it, like you know, Crazy Eddie or those selling commercials from the 80s on TV, you'll hear people at car dealerships, no, we're slashing prices. What are they talking about? They're bringing down the price. Bears slash down, bulls gorge up. So that's where the bulls and the bears came from. Okay, so clear example. Okay, you're looking at something like this. This is the most bearish candle. Meaning what? Meaning there is no wicks. Okay, there were no, you know, the price was up here, but no, it opened and it was straight selling volume, clear down. Okay, and same thing here. The price got this high. This is the second most bearish. Why is it the second most bearish candle? Because the price actually got this high. At one point, the buyers were in control of this market. The price got this high, and then the selling pressure forced this all the way down here. So at this point, you would know, like, damn, there's a lot of sellers in here. And then you could look down at the volume down at the bottom, you know, on your screen there. You could look down at the volume, and the volume would correspond to that. You'd be like, yeah, wow, there was a lot of, you know, there was a lot of people that were, you know, selling in there. This would be a normal bearish candle. Okay, like what we saw on our last picture, because you have a highest price reach, lowest price reach, and this is the body. This is neutral bearish. What does that mean? What does this mean? This means when you see a candle like this, that there was equal selling and buying pressure from each side of this candle that squished it into a little sandwich. You had buyers on the bottom anxious to buy it up, sellers anxious to sell it off, and they squished this in the middle here. Okay, this is squished in the middle between equal buying and selling pressure. Okay, nobody's in control right now of this market. Now, why would this one on the last one here be the least bearish candle? Well, now think about it. Okay, all this candle is the first candle here. Okay, you had a full bearish candle, and then there were so many buyers down there that they bought this all the way up. They bought it all the way up to here. Okay, this was that means the price got this low, and then buyers bought it all the way up here, and this is all you have left. Now, there's a good chance when you see something like this that your next candle is going to start off green, and it might start off somewhere around here where this price action is at and keep hitting up, because that means that buyers are in control of this market. They bought this up, or they're getting ready to take control of this market, and that's what you have to remember. And we don't need to really go any further. If you look at this chart, this is the same thing, just in reverse. Most bullish, second most bullish. Bears were in control. The bulls came and they bought it up. The buyers came and they bought this candle all the way up to here. So this is a very good indication. When you see something like this, especially after something like this, when you're looking at a dump like this, where it's just down, 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 and then the next one down here starts off like this, this is a good indicator that the buyers have just taken control, and that you're getting ready to start heading upward now, and you would be validated. You would be proven right if the next candle started here. So I don't really want to get into strategies yet, but that's what all these represent. Naturally, this one here, once again, would be equal buying and selling pressure from each side. This one would be the least bullish. Why? It's exactly the opposite of this one. There were so many buyers. They bought it up, bought it up, bought it up, and then sellers came and crushed it. Boom, all the way down here. And when you'd see something like this, there's a good chance your next candle is going to start down here. Remember about where red candles open at the top. So it's going to start down here where this one finished, and it's probably going to continue to dump down. So that's it, and we've come in at around, we're coming up on exactly 20 minutes. So it looks like these lessons will be about 20 minutes, guys. And I don't believe I skipped anything I wanted to go over. That is the anatomy of a candlestick. Just remember that. Wicks are simple. Doesn't matter what candle you're dealing with. If it's a wick on top, that's the highest the price got. If it's a wick on the bottom, that's the lowest the price got. The middle's the body. Remember the bullish candles, the green ones, open on the bottom because the price is ripping up. They close at the top where it finished off. Bearish candles, selling candles. They open generally where buying candles stopped, and sellers push the price down, 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 and this is where they finish out. Okay, this is the lowest the price got, and this is where they finish out, and that's that. So see you next time. I'll get the next one up probably today. Be immediately. I'll get the next one up. We're going to get into the next one. I haven't figured out yet, but I am going to pull up this chart. I'm going to show you something of what we're going to get into now, because now we're going to start talking about what the hell are all these little squiggly lines. Everybody's going to want to know. These lines are called moving averages, and our next lesson is going to be on moving averages, because believe it or not, I told you before, what I'm going to teach you is going to be so simple for trading. You're not even going to have to write this down. This is not some best kept secret. It's not some strategy that I invented, some secret strategy. If you pay me $199 a month, I'll teach you my, trick to make a fortune. It doesn't work that way. This is a very simple strategy. You don't even need to write this down. And when I get done, once I tell you what these moving averages mean, and what this line here means, called the VWAP, then we're going to be ready, and I'm going to show you the simplest way to make money using 2 lines on this chart. And that's it. So, see you next time. Get ready. We're almost there. All right. Bye.